In this video, we'll talk about internal controls over cash, why they're important, and how businesses can use simple procedures to reduce the risk of theft and mistakes. Even in today's digital world, many businesses still accept cash. And cash, unlike other assets, is easy to steal, easy to hide, and difficult to trace without the right controls in place. The fraud triangle explains the three aspects that exist when fraud occurs. One aspect is that the employee who commits fraud or theft is experiencing some kind of pressure, perhaps money problems. The employee might also rationalize the fraud by saying that the company has so much money, it's only fair that employees get their fair share. The third aspect, in my opinion, the most important one, is the opportunity to commit fraud exists. Without the opportunity, the employee might experience pressure and rationalize fraud, but they won't be able to commit fraud. That is why good internal controls are so important. Weak controls over cash create the chance to steal. Internal controls like segregation of duties, reconciliations, and locked cash drawers reduce this opportunity. While controls can't eliminate the pressure and rationalization, limiting opportunity breaks the triangle and deters theft. Cash is the most liquid and vulnerable asset a business holds. There's no waiting period, no passwords, no tracking, unless we create those systems ourselves. Because of this, businesses must design controls to monitor how cash is received, stored, and recorded so it doesn't go missing, intentionally or accidentally. There's also the hidden costs of accepting cash. Cash handling requires security risks like late-night bank deposits or on-premise robberies. In addition, businesses often pay for insurance to protect against loss or employee theft, another cost of dealing with physical cash. Digital payments can reduce these risks and costs, but require their own controls. Internal controls also shield honest employees by creating clear procedures and accountability trails. This prevents false accusations and removes suspicion when issues arise. Documentation supports integrity. The most basic and most important control is requiring a receipt for every transaction. This creates a paper trail so there's a record of every sale and how much cash should be in the register. The business also then reconciles those receipts to the financial statements. All the sales receipts should translate into revenue on the income statement. All cash sales and all credit sales should add up to the total sales, and so on. If cash is received but not recorded, there is no way to detect theft unless we compare what's physically there to what's recorded. And that is why the cash reconciliation is so important. Unless receipts are required and those receipts are reconciled, theft may go undetected. Without a receipt system, a cashier could sell an item, not ring it up, and simply pocket the cash. That's why you sometimes see signs at restaurants that say, if you don't get a receipt, your meal is free. It's not just good customer service, it's a way to keep employees honest and accountable. Cash should never be sitting out in the open or easily accessible. The cash drawer should only open when a transaction is entered into the register. This ensures that every time cash is handled, there is a corresponding entry, creating a trail that can be followed. Small changes like this significantly reduce the opportunity for theft. That also applies to the petty cash drawer in the office. It should always be locked, and only one person should be responsible for opening the cash drawer and giving out cash for small expenses. At the end of each business day, the cash in the drawer is counted and compared to what the system says should be there. This daily check helps catch errors and identify suspicious activity early. If there is a difference, it needs to be investigated immediately before it becomes a pattern or ongoing issue. Companies also track cash variances by store location, time, and employee to understand where issues may exist. There may simply be a training issue, or another more serious issue. A key principle of internal control is the separation of duties. The person who takes the deposit to the bank should not be the same person who records the deposit in the accounting system. The person who invoices sales should not be the person accepting or recording cash payments. This reduces the risk of someone misreporting or stealing funds without detection. Even in small businesses, finding ways to divide responsibilities is critical. If separation of duties is not possible, there need to be additional controls that detect theft, cameras in locations where cash is accepted, and strict review of all receipts and reconciliation against goods in inventory and sold. Many businesses also receive payments by mail, cash, or checks. In these cases, internal controls are even more important. Ideally, the person who opens the mail and handles the deposit should not be the one recording and posting payments to customer accounts. If at all possible, the remittance advice, which tells us what the payment is for, should go to accounting, while the cash or check goes to someone else. This helps prevent misappropriation and ensures customer accounts are properly updated. At least once a month, preferably more often, the business should reconcile the cash ledger to the bank statement. This means checking that what the books say matches what actually hits the bank. Any discrepancies should be reviewed and resolved, and they might point to errors, delays, or fraud. Regular reconciliations help maintain accurate financial records. Let's summarize what we learned. Always issue receipts for every cash transaction. Keep cash locked and only open the drawer for legitimate sales. Use separation of duties. No one person should control an entire transaction from start to finish. For payments received by mail, split responsibilities between handling and recording. Perform bank reconciliations regularly to ensure your records are accurate and complete. Remember, good internal controls aren't just about preventing theft. They also build accountability, accuracy, and confidence in your financial systems.